The Rebel Capitalist Show.
The first thing I'd like to discuss is gold. And it's kind of almost out of favor right now, believe it or not, although the central banks are still, or the Fed at least, is still doing 120 billion of quantitative easing every single month, and we've got $5 trillion deficit in 2020. Who knows what it's going to be? We just had a $1.9 trillion stimulus. We've got Janet Yellen saying that she's going to spend over $1 trillion out of the TGA, which means new money supply. Yet gold has been going down, and I guess it's because of real interest rates. So can you kind of give us your opinion on gold and how the real interest rates affect the market, maybe what you see in the future?
Well, that would certainly be my argument, George. I've, in the 45 or 50 years I've been in the gold trade, I've noticed that the primary mover for gold is fear, but more specifically, fear of people's ongoing purchasing power, the purchasing power of their savings in conventional instruments. And the most important determinant from my point of view has been the both nominal and real interest rate on the U.S. 10-year Treasury, which is the world's benchmark security. You'll note, looking back over 2 years, that the period that saw the decline in the 10-year from 200 basis points to 60 basis points corresponded with an increase in the gold price from $1,100 to $1,900. The subsequent increase in the interest rate on the U.S. 10-year Treasury from 60 basis points to 150 basis points coincides with first the plateau and then the decline in the gold price. So I think it's completely consistent, if not perfect, to equate strength or weakness in the gold price with real and nominal interest rates. It's important too, George, to understand that there's some variability around that depending on crisis. And we've enjoyed 40 years of relatively benign economic climate with declining interest rates and reasonably good debt equity markets and reasonably good economic conditions. So people are more less cautious, more confident than they would have been in a less benign economic circumstance. People need to understand in terms of gold that even at 150 basis points, the real yield on the U.S. 10-year Treasury is negative. Mm-hmm. The trailing estimate of the Congressional Budget Office is that the purchasing power of the currency declines at 1.6% compounded. So what the U.S. government is really saying is that if you give them money now, they will give you back less in the future, precisely 10 basis points less. So I think the case for gold is still very good. It's just that the case for gold is less obvious. For me personally, the decline in the gold price, since I would like to buy a bit more gold and some more gold equities, is very positive. I believe that the wind is in gold sails, and I'm confident enough in my thesis that I am happy rather than unhappy to see the price of gold decline nominally and the price of the gold equities decline fairly substantially, because it gives me an opportunity that was certainly missing in July and August to acquire high-quality gold equities at reasonable prices. They had, I think, probably gotten ahead of themselves, and I think they're now very well within the buy range using normal valuation characteristics.
Right. So if the 10-year Treasury yield going up means lower gold prices, typically, where do you see the interest rates on the 10-year being capped, like yield curve control, or do you see the inflation rate starting to exceed the rate on the 10-year, or how do you think that plays out to where the gold price reverses course?
That's the $64 trillion question. I am one who believes that the Fed is allowing the interest rate to rise so that they'll have some ammunition to play with if they need to in the future with regards to the economy. And I personally believe that they'll need to. I believe, too, that as the yield on the 10-year flows through to different credit markets, as an example, the 30-year mortgage market, the consumer durable and automobile market, and also the funding rate for federal, state, and local governments as they refund their short-term obligations. I believe, I hope I'm wrong, but I believe that the economy isn't going to be strong enough to sustain those higher interest charges. I think that there's a very large constituency of voters and others who love artificially low interest rates, and I think that those constituencies will put pressure on their elected representatives on both sides of the aisle. And the elected representatives on both sides of the aisle, I think, will be very accommodative with regards to pressing for lower interest rates and also continuing with the stimulus packages. I believe myself that the gold bull market continues until you see an end to quantitative easing, which may never happen, until you see a U.S. budget deficit that is substantially less than the economic growth rate, the GDP growth rate of the country, and until interest rates revert to mean. By the way, reverting to mean, if you look back over 30 or 40 years, the interest rate on the U.S. 10-year Treasury has been between 150 and 200 basis points real versus the CPI rate of inflation, which would call for, if we reverted to mean, a 400 basis point or 4% yield on the U.S. 10-year Treasury. My suspicion is that that would send a real shock into credit markets and would probably be, in this political environment, unsustainable.
Right.
The bottom line behind all of that stuff is I suspect that what we're seeing right now is a buying opportunity for gold rather than structural weakness in the gold or gold equities markets.
Yeah, I think that's very consistent with my view as well. So the Fed sits back and says, okay, we're going to keep the Fed funds rate at zero. The short end of the yield curve is going to be right at zero because there's so much demand for those T-bills in the repo market and dollar funding. That's kind of a different ball game. But we're going to let the long end of the curve continue to go up, although we're buying $80 billion of treasuries every single month through QE. But aside from that, we're going to let it go up until something breaks. And then once something breaks, whether it's the stock market going down, and the Fed says in a disorderly manner, that's the verbiage they always use. So until the stock market goes down disorderly by, let's say, 20% or 30%, or they start to see cracks in the economy, whether it's auto loans, whether it's the housing market, then the Fed comes in and implements yield curve control by buying as much as they possibly can or need to of the long end of the curve, in which case the market is offsides, because as far as the gold market, because they're expecting the real rates to continue to increase or the treasuries to go up, and all of a sudden the Fed says, nope, we're doing yield curve control. Then all of a sudden you get a huge price swing in gold. Is that kind of how it might play out, you think?
Yeah, I think that's the half of it. I think the other part goes like this. Institutional investors worldwide manage now substantially in excess of $100 trillion. Traditionally, 60% equity, 40% debt. And that's worked traditionally. When the economy is soft and equity prices fall, the interest rate falls, and so the bonds appreciate. The capital appreciation of the bond offsets the decline in equities. Right. That works fine if you have a positive yield, if you have a positive carry on your bonds. But if you don't have a positive carry on your bonds, if you have a negative carry on your bonds, all of a sudden there's sort of $50 trillion a year in bond holdings in institutions that are giving the holders a negative real yield, and they disintermediate out of the bond market. And some of it probably, I'm not trying to say that 40 or 50 trillion goes into gold. That's wrong. But some amount of it goes into bonds. Goes into gold. And right, if you're talking about a fairly small fraction of a number that's $50 trillion, that does an interesting thing to the gold price.
Right.
We discussed this. I don't know if you remember, but the last time we talked about the fact that gold, precious metals and precious metals related equities are very underowned historically.
Yeah, right.
They comprise less than half of 1% of savings and investment assets in the United States, against a 3-decade mean of between 1.5% and 2%. So I'm not one of those really crazy gold bugs who suggest that gold is going to win the war against the U.S. dollar. I just think it's going to lose it less badly. I think we're going to revert to mean. And if we revert to mean, for the reasons that you and I have just talked about, we're talking about a tripling or quadrupling of demand for precious metals and precious metals equities in the largest savings and investment market in the world. And that's precisely what I think is going to happen. Nothing dramatic, just a reversion to 40-year mean.
Yeah, right. So the pushback I know I'm going to get from a lot of people are to say, well, Rick, they're not going to do that anymore. They're going to go into Bitcoin instead. Bitcoin is the new 10-year treasury competitor. So what would you say to that?
I think that Bitcoin and gold are complementary assets, except around the fringes. There's a group of people in the world who think that gold is going to go to $15,000 and they think that Bitcoin's going to go to $1 million or something like that. God bless them both. I mean, I get it. The speculative fringe will do what they do. I think they're very different types of asset. The utility afforded by Bitcoin as a medium of exchange is the size of the network. I get that. But the very volatility in Bitcoin that attracts speculators reduces its utility as a medium of exchange unless you live your whole life denominated in Bitcoin. With the volatility that you see now, if you go to buy a bag of groceries with Bitcoin, you don't really know what you paid, and the grocer doesn't know what he or she got.
All right.
The utility of gold is very different. It isn't a promise to pay, it's payment in and of itself. And the lack of volatility discourages speculators, but it is useful in terms of medium exchange and store of value. And in truth, George, when you look at either of them, the market cap either of precious metals or of Bitcoin, relative to the $450 trillion in savings assets that exist around the world, I think the market capitalization of Bitcoin is about $1 trillion.
Yeah, right.
The truth is that they're both pimples on an elephant's behind. They really, really, really don't matter, except for the sort of fortunes of, in most cases, speculators.
Yeah,
for the rest of us, they're probably compatible asset classes and not in competition.
Yeah,
I would say that the competition for gold, at least in North American markets, as a store of value and because of the liquidity, even as a medium of exchange, is the S&P 500. I think the real competitors for precious metals and precious metals related assets in an inflationary environment will come to be the S&P 500. And I believe there's lots and lots and lots of room for both.